Hello everyone, welcome to uh, International Corporate Finance, Semester 2, Week 11. This is video lecture number 6 and the topic is long-term project appraisal techniques. Okay, so it's a form of long-term planning. So how I'm going to approach this video is there's a question here, Nevada Limited, and we'll read that question and pick out the relevant points in it, and then we might review some aspects of the theory around project appraisal, and then we'll do the question. Okay, so this is a revision lecture, of course, and so let's get on with it. Okay, so let's just read this. Nevada Limited is planning a new long-term project. Okay, so we're talking about long-term planning. Okay, so we're talking about long-term planning here. So this compares to what we were doing with our business planning in earlier lectures, when we were talking about a short-term business plan, which comprised of the cash budget, projected profit and loss account, and projected balance sheet. So here we're talking about more long-term planning. So it could be very long-term, 50 years, 20 years, or really anything over 1 year. Okay, so Nevada Limited is planning a long-term project which will require an investment in machinery of 400,000. So we've got to buy some machines, and we've got to invest in working capital here. Okay, so working capital, as you know, are things like stock, debtors, cash, things like that kind of an investment. So so that's that. All right, so most of these or all of these projects really involve a cash outlay at the beginning, okay, and a gradual cash inflow throughout the project then for a number of years. And this would usually involve maybe a new division in a company, maybe a new factory, some kind of investment like that, or a new product might be launched. But really it could be anything. So it could be something as simple as buying a new machine. Also, this technique is used for the valuation of bonds, which I suppose is like a long-term project. There's an outlay at the beginning when you buy the bond, and there's a return then, a cash inflow from interest payments and from when you redeem the bond at the end. So this can be applied to many kinds of investments that involve cash out up front and then a cash inflow for years afterwards. Okay, so what we're trying to decide is, should we go ahead with the project? Is the project worthwhile? That's really what we're about. So we're going to gather information, or we'll be given in an exam question, you'll be given information about the various kinds of cash out and cash in on the project. Okay, so here's two bits of cash out. At the very beginning of the project, obviously, we've got to invest in machines, and we're going to invest in working capital, and you've got the amounts there. Okay, so let's look at some of the other cash flows then. We're told that the project is going to last for 5 years, so it's long term, as we said, and it's going to generate sales revenue throughout the life of the project. Okay, so here's our sales revenues. So these will be invoice sales, I suppose, that we're going to, for an accounting kind of measure of what the revenue will be. So we may have to, as we'll see, we may have to translate these accounting measures of revenue into what we're interested in is cash flows. Okay, so just to bear that in mind. So we've got sales revenues there, and we may have to turn them into cash flows. So we'll see how to do that later. So each year we have what we anticipate in sales. Now there's some additional information here. Then there's we're going to give credit on these sales, so that'll affect the cash flow, obviously. So if we're making sales, there's going to be a delay in getting the money, and it's a 4-month delay. And we're told that the sales are assumed to occur evenly over the year, but we're giving 4 months credit. So we'll see the implication of that shortly. The next thing then we're told is that there's a gross margin. Okay, so you might remember this idea of a gross margin, and when we're talking about gross margin, we're talking about the trading account, I suppose. So we're talking about the sales of the business, okay, the sales of the business, and the cost of the sales. This is in the trading account, the cost of the sales. And the difference between those two figures is, of course, is the gross profit. Okay, so the gross profit. So the gross profit, let's just pick simple figures. Let's say the sales for the year are 100, okay? And if we're talking about a gross margin, we know the gross margin is the percentage of our sales that is gross profit. So we're told that the gross profit is 80%. So that means in this simple example, the gross profit will be 80. And then we can easily work out what the cost of sales must be. The only figure that when you subtract it from 100, it gives you 80 is 20. So a gross margin of 80% automatically means that it's going to be a cost of sales percentage of 20%. So that if our gross profit is always 80% of our sales, our cost of sales, which is the purchase cost of our sales, is going to be 20% of the sales. So if we're trying to work out then this, when we're talking about purchases of stock, okay, we want to work out what our purchases of stock is. We can do that by at least the purchase cost of the stock that's sold. At least we can easily work it out. If these are the sales figures, we just get 20% of it. Now, of course, there is the opening and closing stock to contend with, but in this analysis and project appraisal, we deal with the changes in stock levels in a different way, as we'll see shortly. Okay, so if we want to find out then what our purchases were, we can assume that it's going to be 20% of the sales. Okay, let's go on now to the other cash flows, and we've got labour costs and we've got overhead costs, and each are estimated to be 10% of sales. So very easy to work out what our labour costs are anticipated to be. We just get 10% of each of these sales figures for labour and 10% for the overhead costs, and that's that. The next thing we have is that we've got some research costs. Okay, research costs in relation to the project. There were 200,000, and these were incurred. So we incurred prior to the commencement of the project. Now remember, when is our project commencing? Well, our project, if the first year of our project is the 30th of June, the first day of our project will be the 1st of July. So prior to the 1st of July, we incurred these research costs of 200,000, but they will not be paid until January during our project, during the first year of our project. So we've got to work out what do we do with these research costs, or costs that were incurred prior to our the commencement of the project. You might remember we refer to these as sunk costs. Well, we'll talk about those shortly. Okay, the next bit of information then is that Nevada Limited's head office, okay, so they've got a head office, so they may have a number of different projects, and the head office has its own costs, and the only way for the head office to recoup its costs is through the projects. It doesn't have a revenue stream of its own, so the projects will have to allocate, if you like, some of their cash to cover the head office costs. So this is done, the head office will decide how much each project has to allocate to cover its head office costs. So they're going to allocate 140,000 of this new project's cash flow to its administration costs. So these are the head office administration costs, okay, and that's going to be done per year as part of the accounting process. So we've got to try and figure out how do we deal with this 140,000, and they also note that actual additional administration costs incurred due to the project, due to the undertaking of the project, will only amount to 50,000. Okay, so we have two figures to play around with there. One is the allocated head office costs that, you know, as part of the accounting process, what's going to be allocated to the head office, and then these are the actual additional costs as a result of the project. So we've got to say which is the relevant cost, which is the relevant cash flow for us. Okay. The next bit of information then is equipment. There's going to be some equipment that has to be purchased. So equipment used on the project. So we already heard that the equipment cost is was it 400,000? I think we're going to buy the equipment at the beginning of the project for 400,000, use it throughout the years of the project, and at the end of the project, 30th of June 2025, we're going to sell this equipment for 100,000. Okay. Now there's also information about depreciation. So we see how do we deal with depreciation in this analysis. Okay. And the last bit of information then is the idea of the cost of capital is assumed to be 10%. Okay, so we'll see how this is relevant shortly. So what we're asked to do then is we're going to use a discounted cash flow project appraisal technique. So, all right, discounted cash flow project appraisal technique of your choice, and we want to assess whether the project should be undertaken. So that's the whole idea of this. In advance, we're going to try and estimate what the future cash flows are going to be on a project and try and work out, is the project worthwhile for us, should we go ahead. Okay, so let's look at a number of points in relation to this kind of analysis, okay, when we're looking at projects. So the first thing we've got to remember is we're talking about what we call discounted cash flow. Okay, so we're going to what we sometimes refer to as DCF techniques. Okay, so there are a number of these discounted cash flow project appraisal techniques, and the one we're going to use today is one called the net present value method. There are others. Okay, so we're going to look at, that's what we're going to look at, the net present value method. Okay, so there are other non-discounted cash flow methods, okay, that we have looked at, non-DCF methods, okay, and we have talked about these in class, and the two main ones, I suppose, is the payback method. Okay, the payback method. Not going to go into it here, but you might remember it, that it's the number of years you get your initial investment back, and the shorter the payback period, the better. So the payback method. And the other one is just a simple return on investment. Okay, return on investment method, or return on capital employed, it's sometimes referred to, ROCE. Okay, now there is another method here, another DCF method, and it's called the internal rate return method. Well, we won't be using that one today. So the one we're going to focus on today is this net present value method. So let's talk in general about these DCF methods. Okay, first thing, when we're talking about project appraisal, what we're trying to work out in advance, is the project worthwhile? Okay, so that's our question really. Is the project that we're undertaking, this long-term project, is it worthwhile? Okay, so that's our question. Okay, and in order to answer that question, we have some kind of, or to make a decision about whether it's worthwhile, we have some what we might call decision inputs, I suppose, into our decision making process. And what we're going to analyze or try to answer this question by looking at two pieces of information. And the first bit of information is, I suppose, is what we refer to as cash flows. So we're going to look at cash flows. Okay, to look at cash flows on our project, cash flows in and cash flows out on our project. Okay, and the other input, decision input, because it's a long-term project, we're going to look at something called the time value of money. Time value of money. Now I'll discuss these two factors in a minute. Okay, the time value of money. Okay, and we know how we deal with the time value of money. You might remember we discount future cash flows, but we'll see why in a moment. Okay, so these are our two decision inputs into our analysis of whether we should go ahead with the project. And what we do is we feed these into our decision-making method, I suppose, and this is what we might call the DCF technique. So we're going to put it in here into this DCF, discounted cash flow project appraisal technique. And the one we're using, of course, today is the net present value method. And based on that, okay, we're going to get an answer. Okay, we're going to get an answer to our question, is the project worthwhile? And the answer is either going to be yes, it's worthwhile, or no, it's not worthwhile. Okay, so that's what we're about here. Okay, we're trying to ask about this project, this Nevada Limited's project, this proposal. Is the project, should they go ahead with it? And we're going to look at the cash flows associated with the project over its life. And we're also going to recognize the fact that money has a value, that the future cash flows will be worth less euro per euro, or €1 compared to another, that future euros are going to be worth less because money loses its value over time. And we're going to put these two factors in, these measurements, these future measurements, cash flows and time value of money, into our discounted cash flow technique, our net present value method. And we're going to get an answer to say yes, we should do the project, or no, we shouldn't do the project. Okay, so let's try a different colour for variety. Okay, so we're going to look at then, I just want to make a few comments about the cash flows and a few comments about the time value of money. Well, the first thing we can say is about cash flows, okay, the cash flows on the project, that we're going to look at cash flows rather than, we're not going to look at profits. Okay, we're not looking at accounting measures. So if we're given information about profits, okay, we've got to convert them, if you like, back to cash flows. So not profits. We're not going to be looking at not profits. Okay, so we're not going to say, will the project make a profit? That's not the way we're going to approach this. Because when we calculate profits is an accounting concept, and accountants measure profits with various rules and as to how they calculate these profits, and this is not really relevant for us when we're trying to make a decision about the future. So, for example, if we're not going to look at accounting measures, so we will not include. So I'll just put in here: do not include depreciation. Okay, because appreciation is accounting concept. It doesn't involve a cash flow. And if, for example, in our exam question, we're told what the profits are on the project, well, we've got to try and turn those into cash flows, and we'll just adjust for any depreciation that was deducted in calculating the profits. So normally, as you know, depreciation is an expense and it's deducted. So if we're given profits in our question, we just add back to depreciation. Okay. Another thing is that we when we're dealing with the revenues associated with the new project, we're going to look at cash received. Okay, cash received, and we're not going to look at the sales. So we, in this example of Nevada Limited, we were given the sales figures. So we've got to try and find, instead of the sales figure, what is the cash? What is the cash that we're going to receive on this project in respect of those sales? So, for example, as you know, let's look at an example. So let's say the year, it's not to do with Nevada, but let's say here's a year one on our project. Okay, this is year one, our first year on the project, and let's say our sales are, let's say 120, let's say they're 12,000. Let's keep the numbers easy. So let's say the sales are 12,000, and we're going to make 1,000 sales per month. Okay, so we're going to break the year up into 12 months, and each month we'll get sales of 1,000. So that's 12,000. Now, if we give 1 month's credit, okay, this final month here, this final month, the cash in respect of the sales of that final month won't be received until the next year. So let's put in the next year here. Okay, this will be year 2. Okay, so here's year 2. Okay, so if we're trying to work out the cash flows, let's say the sales in this year have doubled. Let's say the sales in this year are 24,000. Okay, that's 2,000 a month. So if we're trying to find out with the cash flow, the cash received, I suppose. Okay, well, the cash received in year 1 will be just 11 months sales. Okay, because the final month then will not be received until year 2. Okay, so this last month, I can just do that. So this last month of sales here, that's our last month of sales, that's December sales, we'll say. Okay, that will not be received until the following month. So if we're looking for the cash received in this month, it'll just simply be 11,000. Okay, the cash received will be 11. So how do we get that? It's just the sales of 12 minus the 1 month's sales, which we won't receive in that particular year. And if we go on to the cash received in year 2, okay, how are we going to calculate that? Well, we've got sales of 24, but the last 2 months of sales, okay, won't be received until the next year, which is year 3. Okay, so how are we going to figure out what the cash received was? Well, we'll start with the sales. Okay, so the sales, the sales of course is 24,000. Okay, but we know that that some of those sales won't be received till year 3, so we're going to subtract. Okay, so we're going to subtract what we refer to as the closing debtors. So the money that's owed by the customers, we sold them goods but they haven't paid, so the closing debtors will be the last 2 months. So the last 2 months, if we're talking about 2,000 a month, the sales of year 2, well, the closing debtors of course will be 4,000. Okay, so we're going to subtract that. Okay, so that'll give us 20,000 out of the sales of year 2 will be received in year 2, but of course we've got this other sales of year 1 that we haven't received and will not receive, so we've got to add on then the opening debtors of year 2. Okay, and the opening debtors of year 2, of course, we said was 1,000. So the cash received then in year 2 will be 21,000. Okay, 21,000. And that's how we get it. Okay, so the 21,000. So that's why we have this adjustment we sometimes make in an exam question. If you're told what the sales are, as you are in this question, Nevada Limited, we're told what the sales are, we're going to have to adjust our sales for closing and opening debtors to figure out what the cash received is. Okay, the next point then in relation to cash flows is this idea of incremental cash flows. Okay, incremental cash flows. Okay, let's do a different color. Okay, so incremental cash flows. Okay, well, incremental cash flows, incremental means additional cash flows, and here they mean additional cash flows because the project takes place. Okay, there are only the cash flows that will only occur if the project takes place, and in this analysis we only include these incremental cash flows. So just to illustrate this point then, let's assume we have a situation, let's draw a timeline for our project. So we have before the project is a period of time, of course, when we're engaging in some kind of research. Okay, this is before the project starts at all. So this is time. Okay, it's kind of a timeline, and we're researching the project, maybe doing maybe we've hired a company to do some market research or engineering research or whatever it is, and a point in time comes here's the point in time that we have to make a decision. So this is our decision time, okay? So we've got to make a decision here. And the decision, of course, is do we go ahead with the project or don't we? Okay, and so what a decision is, of course, is just a choice of alternative courses of action. And the two alternative courses of action that we have is we're going to either say yes to the project, okay, or we're going to say no to the project, okay. Now we're going to have cash flows. We're going to have cash flows before this decision is made, and we're going to have cash flows after this decision is made, okay. And we're only going to include those cash flows that will occur if we say yes to the project, okay. That's what we mean by incremental. So any cash flows in or out that occurs when we say yes and doesn't occur in other cases, okay. In other words, it doesn't occur if we say no to the project. That's what we mean by incremental. So if we're looking at a cash flow, if a cash flow is going to occur either way, if we say yes or if we say no, so if it occurs in either case, well then that's not incremental. And an incremental cash flow is one that occurs only if we do the project. Okay, so we've a situation then where we might have cash flows here prior to the project, like research costs, and we refer to these costs that are prior to the decision, okay, prior to the decision point, okay, and we refer to these as sunk costs or sunk cash flows, okay. So we've already sunk them into the project, and whether they're paid for or not, they may have to be paid after our decision point, but if they have to be paid for after a decision point, they're going to have to be paid either way, okay. So even if we reject the project, these sunk costs have to be paid, therefore they're not incremental. So we always say that any past costs, okay, prior to our decision, they're not incremental, and any costs that will occur either way, whether we say yes or no to the project, are not incremental. And we're only going to look at cash flows that occur only if we proceed with the project. Okay, so that's incremental. So incremental, really important idea in project appraisal. Okay. The next point I just want to make before we start, okay, well, another point about cash flows rather, is the idea of working capital. So let's just talk about working capital for a minute. So in this example with Nevada Limited, we have working capital. We've got to invest in working capital. And another term for working capital, I suppose, is net current assets. Okay, as you might remember, you do, I'm sure, net current assets. And net current assets are simply current assets minus current liabilities. Okay, current assets. And minus current liabilities. Okay, and we know what the current assets are. Okay, the current assets are stock. Okay, they're debtors. And it's cash as well on the balance sheet, whether it's in the bank or wherever it is. So there are current assets, and our main principal current liability, of course, is creditors. Okay, so if we want to find out what our working capital is, we add up at any point in time the value of our stock, the value of our debtors, value of our cash, and we subtract the value of our creditors. So how do we deal with this idea of working capital? So working capital is an investment, just like buying a machine or buying equipment is an investment. We invest in working capital. It costs us money. We've got to pay cash out for it. Okay, so I suppose if we take an example of one of them, let's take an example of stock. Okay, let's take an example of stock. So let's take an example of stock and how we invest in stock. Okay. and is this investment cash in or is it cash out for the project? So let's say this is time here. We've just drawn a little graph. Okay, so we'll say, let's say we've got 4 years on our project. Okay, there the years: year 1, year 2, year 3, and year 4. And here's a year 0, I suppose, the very beginning. That's the notation of our, in this instance, we call year 0 the very first day of our project. And let's say we'll pick just the stock as an example of working capital. So these are our stock levels over the duration of our project. Okay, and let's say here's a high level of stock. You won't put a number on it. And here's a low level of stock. Okay. Now we'll just say our investment in stock, if we're buying stock, if we're stocking up for the project, is this cash out or is it cash in? Okay, is it cash out or cash in? Well, clearly, if we're buying stock at the very, very beginning of our project, I'll try to do this as best I can. If we're going to stock up and buy a load of stock at the very, very beginning of our project, well, that's the line. We're going to have a high level. We're going to buy a high level of stock. Well, that clearly, therefore, is cash out. Okay, that's cash out as far as so I just put that in there, cash out. We're stocking up. Okay, so when we increase our stock levels, that's cash out as far as we are concerned. And gradually, then over the period of the project, we sell this stock, or we incorporate it into production, or whatever we do. But we sell it, and when we sell it, I suppose that's cash in. Okay, that's cash in. So anytime we sell this, is cash in, I should have said. Okay, so it's cash in. Okay, and this happens throughout the project. Okay, when we reach a certain level, a reorder point, we purchase more stock over a period of time, and that's cash out again, and then we'll gradually sell that stock or use it up, and that's cash in again, and this goes on all the way through the project. Okay, all the way through the project. Okay, until maybe towards the very end of the project. Okay, we've stocked up maybe for the last time at some stage in the last year, and then gradually we know we're coming towards the end of the project, so we don't reorder anymore. When we gradually sell off our stock, and we're coming towards the end of the project, and we hopefully come down to 0 levels of stock, and the project is over. So anytime the stock comes down, it's cash in. Anytime the stock levels go up, it's cash out. So this very last time here that we use up our stock, this is cash in. Okay. Now, as a simplification, when we're doing our calculations in project appraisal techniques, what we do is we look at the first time we invest in stock, okay, a certain level of stock, and we say that's cash out. And we ignore everything in between, the ups and downs in our stock level, okay, unless we're going to a higher level, unless at some stage we say, well, we're actually going to stock up even more for some reason, well, then it'll be more cash out. Okay, and what we do generally is in between we ignore all the ups and downs, and at the very end of a project we take account of the cash in, okay, when we sell our stock for the last time. So it's kind of a rule, I suppose, with working capital, whether it's stock or any other kind of working capital, that in the beginning, in year 0, okay, we say that the investment in working capital is cash out, in the same way as when you buy a machine, it's cash out. And at the very end of the project, when you're stocking down, if you like, getting rid of all your stock, that's cash in, and we ignore all the cash flows in between, to simplify it. Okay, in the same way as when we sell a machine at the end of a project, it's also cash in. Okay, so that's working capital. Okay, I hope that was clear enough. The next thing that is relevant for our example here is something called head office costs. So let's talk about head office costs, because we talked about in Nevada Limited there is some head office costs. Okay, so let's have a look at that. These are cash flows, of course, of a type. Okay, these head office costs. So here with head office costs, we're talking about a situation where we have a head office. Okay, here's our head office. Okay, and let's say the head office costs of running the head office, this has nothing to do with Nevada now, but let's say the head office costs, the head office of a particular company, let's say the head office costs are 120,000 a year. 120,000 a year. And let's say, of course, in this head office they have, or in this company rather, they have different projects. So let's say at the moment they've only got 2 projects. Let's say project 1 and they've got project 2. Okay, project 2. So let's say there's only 2 projects. Well, if the head office needs to cover these expenditures that it has in rent or salaries or whatever the head office costs are, it has no revenue stream of its own, so it relies on the 2 projects to pay money. And they do this, and the management will decide how much each project would spend. So let's say these projects are similar in size. What would happen is that perhaps this 120,000 would be split between the 2 projects. So project 1 would have to pay 60,000 to cover the head office costs, and project 2 would also pay 60,000. So now we're coming to a situation that we're dealing with, and we're talking about a new project, okay? And they're talking about this other project over here, okay? And they're wondering whether they should proceed with this project. And this is project 3, okay? This will be project 3, but we're not too sure yet. We haven't made a decision, okay? And the question is, what if we're told that the head office costs are allocated, that's the term, allocated between the projects equally, let's say, okay? It means now that from now on, if there's no additional head office costs due to our project, that the head office costs now will be split 3 ways. So the 120 is going to be split, divided by 3, so we're going to have 40,000 contributed by project 1, 40,000 by project 2, and 40,000 contributed by our new project. And the question is this 40,000 incremental? Should it be included in our calculations on making a judgment about the project? And the answer is, we say no, okay? That this 40,000 would not in itself be regarded as incremental. And there would only be incremental head office costs if, because of our project, there may have been additional head office costs. So if there's additional head office costs, let's say they had to hire a new employee to look after our project, for example, and that costs 30,000, let's say, well, that 30,000 then is incremental. It has occurred because of our project, okay? Whereas this 20,000, even if we say no to our project, this 20,000 will be incurred and will be allocated between the 2 projects. But it's only additional or incremental cash flows that we consider. So we won't consider the 40, but we would consider the 30. Okay, so that's really all I want to say about cash flows. Okay, so if there's any other issues in relation to cash flows, we'll consider it. Okay, the other input, if you remember, into our decision-making process at the top of the lecture was this idea of the time value of money. Okay, so let's just talk about the time value of money. Okay, the time value of money. Well, the time value of money is the idea that present money is more valuable than future money, euro per euro. Okay, that a euro today is worth more than a euro in the future. Okay, so any cash flows we get on our project in the future is going to be worth more to us, it's going to be worth less to us than any cash outflows that we might have now on this project. And the reason for this is threefold. Okay, so why is there a time value of money? Okay, and the first reason is to do with inflation. Generally speaking, we have inflation, that prices go up. year on year, sometimes more in some years than in others. But generally speaking, periods of deflation are rare. So if inflation occurs most of the time, well, that means that the purchasing power of money, of euros, goes down over time. So future euros will be able to buy less than present euros. The next reason is, of course, that there's if we have money today, if we have a euro today, we can put it in the bank and we can earn interest on it. And when, if we're comparing it to a euro in 3 years' time, we'll have made interest. So it's better to have money early rather than later. And a third reason why we incorporate this time value of money into projects is that projects are risky. There's an element of risk in projects. Okay, so if we're talking about cash flows now, they're more or less certain. Okay, if we're going to spend money out today, we're spending them out. We know we have to spend them out. There's no uncertainty there. But if we're waiting for money to come in on a project, they may come in, they may not come in. So we find that the more the risk, the greater the reduction in value in money. So how do we deal with this? How do we compare future cash flows and present cash flows on a like by like basis? Okay, and how we deal with it is we deal with it by discounting the future cash flows. Now there's probably other ways it could be done. Okay, this is the way it's done in practice. So what we do is we discount or reduce any cash flows that occur in the future, and the further away they are in the future, the more we reduce or discount them. So what is this idea of discounting? It's a mathematical kind of technique, I suppose, and it's similar to something you're very familiar with. Okay, and what concept that you're very familiar with from school, I suppose, is this idea of compound interest. Compound interest. So discounting is the opposite of compound interest. So let's just briefly review compound interest. So we're talking about compound interest at 10%. Okay, let's talk about, let's say, the idea that you have, let's say, 100 euros today. Okay, and we'll call this the present value. Okay, if you like, the present value is in year 0, y0. Okay, and we're going to put that 100 euros in the bank. Okay, going to put it in the bank, and as we know, that it will amount to something higher in a year's time because of interest. Okay, so the amount that it's going to amount to, the future value, if you like, I'll just say FV, the future value, which is in year 1. What we mean by year 1 is in 1 year's time, exactly 1 year away. So compound interest, the money moves from a present value of 100 to a future value of 110. So how is that calculation done? Well, it's simply done, you have the present value and you multiply it by 1.1. Okay, in other words, the 0.1, the 1, if you multiply it by 1, it stays at 100. If you multiply it by 0.1, that's 10%, you get 10 euros. So it amounts to, so that's equal to, obviously, 110. So that's how we do compound interest. Okay, let's do it for year 2. Okay, let's do it for year 2. Let's say we've got 100 here. This is our present value again in year 0, and we want to see what it is in 2 years' time. Okay, in 2 years' time, this is the future value in year 2. Okay, so what does it amount to? Well, actually what it does amount to is 121. Okay, if we put 100 euro in the bank, okay, and it earns 10% in the first year, it becomes 110, and then we get 10% of that, and it becomes 121. So how do we calculate that? Well, it's easy. It's 100, and for the first year we multiply it by 1.1, and then for the second year we do it again. We multiply whatever we get there by 1.1. Or another way of writing that is it's 100 multiplied by 1.1 to the power of 2. Okay, and that's how we get to 121. Okay, so this is simple. This is not simple interest, it's compound interest, but it's fairly straightforward. Let's do it for a third year then. Okay, again, we've got a present value. Okay, in year 0 as before, and it's €100. And we want to go this time, we want to go 3 years into the future, okay, and to get our future value in year 3. Okay, now what it amounts to, as we'll see, is 133 and 10 cents. Okay, so how do we figure that out? How does it become that? Well, it's just 100, and we put it in the bank at 1.1, and then we multiply it again by 1.1, and then we do it 3 times 1.1. So that gives us 100 multiplied by 1.1 to the power of 3, and that's how we work it out. Okay, so that's compound interest, something you're familiar with. Now discounting is just the opposite of that. In other words, we start with the future figures, okay, and we work backwards, okay? We work back to the present value. So it's just a reverse, okay? So let's have a look at that, okay? So this is discounting. Oops, I'm running out of space, okay? So discounting, let's just try it, okay? Okay, so let's do the discounting for year 3. Okay, let's just do it for year 3. So we've got a future value. Okay, this time we start with future value. So just put in here discounting. So we've got a future value. This is in year 3, 3 years time. Okay, and we said it was 133. Let's say that's our cash flow on our project or whatever in year 3. And we want to bring it back to its present value, so that we compare it with money we're going to spend out on our project in year 0. But so what is that 133 in today's money, if you like? What's the present value of it, okay, in year 0? So how do we do it? Well, we do the opposite of compound interest, okay? We do the opposite of compound interest. So we start with 133.1, which is our future value, and instead of multiplying by 1.1 3 times, we're going to divide. So how do we divide by 1.1? Well, we multiply it by 1 over 1.1, okay, and then we do it again, multiply it by 1 over 1.1, which is we're really dividing by 1.1, and we do the same again for the 3rd year, okay? Or another way of saying it is, it's 133, the actual cash flow, divided by or multiplied by 1 over 1.1 to the power of 3. So you can see it's just the opposite of what we were doing with compound interest. And that, of course, gives us the answer, which, of course, is 100. Okay, so that's 100. Okay, so they're the kind of underlying concepts, I suppose, in relation to project appraisal, long-term project appraisal, discounted cash flow. Okay, and in our next video we'd actually do the question. I was hoping to get it done on this in this one, but I just don't have the space. So in our next video lecture we will actually do the question Nevada Limited. So hope to see you then. All the best.